In March 2020, while most of the world was panic buying toilet paper, something far more consequential was happening in the currency markets. The Brazilian real collapsed 28% in 3 weeks. The South African rand dropped 35%. Indonesia, Mexico, Colombia, currencies were in free fall. Not because their economies had failed, not because of corruption or war, but because investors needed dollars, fast. Within days, the Federal Reserve opened what they call swap lines to 5 countries, unlimited dollar liquidity, as much as they needed. Crisis averted for those 5 countries. 60 other countries waited by the phone. The phone never rang. This isn't a story about fairness. It's about a system most people don't know exists. A system that decides, in moments of global panic, who gets a lifeboat and who gets left treading water. And the criteria for that decision? Well, that's where things get interesting. Let's rewind for a second. When we talk about financial crises, we usually think about banks collapsing or stock markets crashing. But there's another kind of crisis that's far more dangerous and far less understood. It's called a dollar funding crisis, and it works like this. Imagine you're a company in Brazil. You do business internationally, so you borrow in dollars. Makes sense. The dollar is stable, everyone accepts it, and interest rates have been low for years. Then suddenly, your currency starts dropping. Now you owe the same number of dollars, but it costs you way more reals to pay it back. You need dollars, urgently. You're not alone. Every company, every bank in your country that borrowed in dollars is in the same position. Everyone is scrambling to buy dollars at the same time. The price of dollars spikes. The value of your currency craters even further. It's a vicious cycle, and it can break an economy in days. This isn't theoretical. It happened in the Asian financial crisis in 1997. It happened in 2008, and it started happening again in March 2020. Now here's the uncomfortable part. Most countries can't just print dollars. Only one country can, the United States, or more specifically, the Federal Reserve. And in a dollar funding crisis, the Fed becomes the only institution on Earth that can stop the spiral. They do this through something called central bank swap lines. Think of it like an emergency credit line between central banks. The Fed says to another country's central bank, "We'll give you dollars, you give us your currency as collateral, and when things calm down, we'll swap back." Simple, powerful, and completely at the Fed's discretion. There's no international law that says the Fed has to help anyone. No treaty, no obligation. It's a decision made in private by a small group of people based on criteria that are never fully disclosed. So, who gets chosen? After the 2008 financial crisis, the Fed established permanent swap lines with 5 central banks: the European Central Bank, the Bank of Japan, the Bank of England, the Swiss National Bank, and the Bank of Canada. Notice a pattern? These are all wealthy, stable economies, America's closest allies, the countries whose financial systems are deeply interconnected with the U.S. When COVID hit and panic spread, the Fed expanded the program temporarily. They added 9 more countries: Australia, South Korea, Brazil, Mexico, Singapore, Sweden, Norway, Denmark, and New Zealand. 14 countries total, out of nearly 200 in the world. Brazil got a line, Argentina didn't. South Korea got one, Indonesia didn't. Why? The official reasoning is about financial stability. The Fed says they offer swap lines to countries where a currency crisis could spill over and threaten the U.S. financial system. That makes sense on paper. If Brazilian banks collapse and they owe money to American banks, that's a problem for America. But here's where it gets murky. The criteria aren't published. There's no checklist, no application process. The Federal Reserve doesn't explain why country A gets help and country B doesn't. They don't have to. And the decision is made fast. In 2020, some of these swap lines were announced within 48 hours of markets melting down. There's no time for debate, no congressional approval. The Fed chair and a few key officials decide. It's technocratic, it's efficient, and it's completely opaque.